Okay, thank you so much for joining me back for our part 3 of our live market analysis with Q&A. My name is Tony Zhang. I'm the Chief Strategist here at OptionsPlay. The purpose of today's webinar is to take stock of what we've learned over the past few weeks regarding risk management, trading psychology, and technical analysis, and take some time to review what we've learned, make sure that you understand what we've learned, and apply it to the live markets. And we want to make sure that the education that we provide, we don't just go from week to week with new topics, that we always take time to make sure that we review the topics and make sure that you understand how to apply the things that you've learned. So today, we're not going to learn anything new. What we're going to do is we're just simply going to, you can hear me loud and clear. Please type yes. Clear. Please type yes. Okay, looks like everyone can hear me. I just want to make sure. Okay, so as I was saying, the goal of today's webinar is to make sure that we review what we've learned over the past few weeks, specifically regarding risk management and technical analysis, and making sure that we take the time to make sure that you understand everything before we move on to the next topics. We don't want these educational sessions to just go from week to week to week without any review of what we've learned. We want to make sure that you take the time to take the topics that we've learned and show you how to apply it to the real markets. So today is really one of those sessions where we take a pause from learning new things and make sure that the things that we have learned, we know how to incorporate them into our actual practice of trading. So before I get started here today, just a quick disclaimer. What we're going to discuss here today is purely for educational purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So for those of you that are brand new to OptionsPlay, you can sign up for the free trial. For a free version of OptionsPlay, which is what I'm going to use here today for Canadian securities using the link that I just posted into the chat window and the link that you see on your screen. This will give you access to the tools that I'll be showing you here today, the options educational webinars, the on-demand video library for the previously recorded webinars, and the weekly reports that we send out on where the current market is with respect to income generating strategies. So for those of you that like to sell cover calls, cash secured puts, these reports are designed to help you understand what expiration dates and strike prices are suitable each individual week so that you can see updated best practices for how to apply these strategies to your portfolio. So that's all free of charge, courtesy of the Montreal Exchange. You can sign up using the link if this is your first time. And I will make sure that I come back to that at the end for those of you that want to take advantage of that at the very end. But first thing we're going to do is we're going to talk a little bit about the market update. The point of these live market analysis sessions is to take what we've learned and apply them to the current market. So we're going to start off by giving you a little background on what we currently see in the current markets, specifically what type of option strategies we believe are suitable for this type of market environment, and then talk through a review of what we learned over the past few weeks, which is trading psychology and technical analysis. Now, before we actually get started here today, how many of you were able to join us over the past few weeks as we talked about trading psychology, which from my perspective is one of the most important topics to learn, and technical analysis? Please type yes into the chat window if you have. And if you did not, or if you missed that, please type no into the chat window, just so I can get a sense for the audience here in the room. Okay, so I see quite a few yeses, but I see quite a few no's as well. So I will make sure that before we end here today, everyone here understands how to access it. We actually have a whole playlist that we created that has part 1, the trading psychology and the technical analysis already pre-built for you. I'll post this link into the chat window for those of you that want to bookmark it and come back to it. So today what we're going to do is we're going to review what we learned over these past few sessions. So if you did attend, today is just going to be a quick review. If you haven't attended, think of today as a bit of a preview for you to go back and watch these recordings. Again, this is designed so that we don't just skip ahead to new topics all the time, that we take time to reflect on what we've learned and apply them to the real markets. And then we'll do some analysis using OptionsPlay, At the end, I will open this up for Q&A for any questions you guys may have. And today's an opportunity for you guys to submit symbols that you want us to all look at together, and for me to show you how I would analyze those symbols, how I would think about whether or not to trade options on those symbols, and see if we can put them into the context of the things that we've learned here. So let's go ahead and get started. Now, my name is Tony Zhang. I'm the Chief Strategist here at OptionsPlay. For those of you that are familiar with my background, I started my career at a company called Forex.com. For those of you that trade Forex, you might be familiar that currency trading is heavily dependent on technical analysis, using charts to determine where currencies might be headed going forward. So I talked a lot about last week how my background and how technical analysis is very integrated into my trading strategy and how I analyze the markets. So I'll give you a review as far as why I value technical analysis so much and how I'm able to utilize it to gain a directional view. And then we'll also talk a little bit about the strategies here regarding trading psychology, which again is I think one of the most important topics as a trader, to understand how you should think about trading, how you should think about your wins and your losses so that you can keep your losses small and potentially have larger wins, because that's really what everyone's seeking. So that's what we'll start off with. So for those of you that answered no, that you did not get a chance to attend, I recommend that you take a look at the playlist that I just sent you so that you can review this after we finish here today. So we'll start off by talking a little bit about a book that was written in 1986 by a person named James P. Carse. And what's fantastic about this is James P. Carse was not a finance professional. He did not have a trading background. He was actually a religious philosopher. But he wrote this book, Finite versus Infinite Games. And for those of you that are new to this concept, or if you've never heard of this concept, especially with respect to game theory, I highly recommend that you take some time and just Google the finite versus infinite game. Read a little bit about it. See how it applies to so many other aspects of your life, that you will find it quite interesting how it applies to so many different aspects of your life, including trading. Because what James theorized is that there are two types of games. There are finite games and infinite games. Finite games are the types of games that we are all familiar with. These are games that have what we call a fixed set of rules to the game, and the game always ends at a certain point. And at that end, there's declared both a winner and a loser, of which when you're playing a finite game, there's only one outcome, or one goal rather. And that goal is to win at basically all costs. You do whatever you can to win at that game, but there are fixed rules to that game, and you know when the game ends, and you know how to achieve a win. An example of finite game are games of football, games of basketball, blackjack. These are all examples of what we would consider a finite game, or the type of games that we typically think of as games. And then he theorized that there was another type of game called an infinite game. And an infinite game is a game that has no agreed upon rules, and it's also a game that never ends. And in an infinite game, what happens is there's no such thing as winning or losing. There are only players and players who drop out, or players who can stay in the game versus players who no longer have either the will or the resources to stay in the game. And I think a good example of for someone to understand what an infinite game is think of it as running a business. Think about running a business. There's no such thing as winning in terms of running a business. You are either in business or you are out of business. And you are constantly competing against a wide variety of players, some of which are known, your direct competitors that you know of, and there may be non-direct competitors or competitors that you don't know of, so you don't know who are all the players in the game. There certainly aren't any rules to business, and your goal is to stay in business and make sure that you don't get pushed out of being out of business, right? That's the goal of an infinite game. And when you start thinking about what things are infinite games, you think about running a business, you think about perhaps even your marriage. There's no such thing as winning in a marriage. You are either married or not married anymore. And there's plenty of other examples like this. And you can have a finite game, such as playing a game of football inside of what we consider an infinite game, such as running a football league. There's no such thing as winning in the football league. You either are the dominant league or you get pushed out by a smaller league to become the next dominant league. So the National Football League or the Canadian Football League, all of these, there's no such thing as winning. There's just a larger league and a smaller league, and some leagues get pushed out because they no longer have a large enough viewership or not enough revenue to stay afloat, of which obviously the National Football League is the dominant league, but they're not necessarily winning. They may be the biggest league today. They may not be the biggest league tomorrow. And that's really the important thing to remember, is that when you're playing a finite game, the goal is to win. When you're playing an infinite game, such as trading, right? If you think about your trading account, there's no such thing as winning in trading. You either have an account that has enough capital for you to continue trading, or you've blown up your account and you no longer have enough capital to continue trading unless you deposit more money. So when you're playing an infinite game, the goal is not to win. The goal is to stay in the game. Make sure that you don't drop out. So whatever, at all costs, your goal is to prevent yourself from dropping out. How do you prevent yourself from dropping out in trading? You prevent yourself from doing that by not blowing up your account. As long as you don't blow up your account, you have enough capital to continue trading another day. That is your goal. So the reason I'm bringing this up is because when I talk to traders, I tend to get a lot of questions from users focusing too much on this concept of winning. Meaning, the types of questions that I get from a lot of investors are, how do I turn the small loss? I place an options trade, it's losing. How do I turn this back into a winner? Because there's this misconception that we have, especially when we're trading, that we're trading a finite game and there's only winners and losers. And you have to win more often than to lose in order to stay ahead. And that's simply not necessarily true. And unfortunately, or the ironic part, is that in the pursuit of winning, in the pursuit of making sure that you have no losers, that's actually where I see most users enter behaviors that cause them to drop out. Now, what do I mean by that? Many times I see someone who has a small loss who says, well, I'm trying to get myself back to break even. I don't want to take this loss. So what they do is they think about, what can I do to get myself back to break even? You can trade another trade. You can add a little bit more risk in hopes that the trade recovers back in the direction that you expect it to. And this is something we see over and over again, right? Sometimes you get into a trade that you think is going to go in a specific direction, but the trade, instead of going in the direction you expect it to, starts to reverse lower. So then you ask yourself, okay, the trade didn't go in my favor, but if I bought a little bit more, if I double down and the stock recovers a little bit more, I can get myself back to break even. Now, this type of behavior is a very slippery slope. And as you can see, the goal of the second trade is to prevent you from losing on that first trade, right? Which I think it's natural for someone to think that, well, if I just make sure that I don't lose, I will be profitable in the long run. But what you see here is that what you tend to find a lot of traders will do is they forget that they're playing the infinite game, which the goal of which is not to win, but the goal of it is to make sure that you don't drop out. So in the pursuit of winning, what we tend to see is that investors, what they do is they forget the fact that their whole goal is to stay in the game. And when you start adding risk to a trade that didn't go well, what you're doing is you're going down a slippery slope of potentially blowing up your account. And I've seen this too many times. I've been a strategist for 14 years, and I have seen retail traders of just about every single possible walk under the sun. And I have seen traders time and time again trade like this, where a trade goes against them. They start finding new ways to justify why they should place another trade to help them get themselves back to break even. And sometimes that trade doesn't work, and they start getting a little desperate, and they start trading much larger size than they originally anticipated when they first got into that first trade. By the time they're in on their third trade, the trade is so large, they really can't afford to have this turn into a losing trade. And this is unfortunately where sometimes we may get a little desperate and we do things that we wouldn't have done originally if we simply just cut our losses on our first trade. And it's so important that we learn to just detach ourselves from this concept of winning because that winning doesn't get us anything. If you're trying to win in an infinite game, what you're going to find is yourself extremely frustrated in the long run, because again, the ironic part is that in the pursuit of winning is actually what is the behavior that causes many of us to ultimately blow up our accounts and lose out in the infinite game that we're playing, which is trading. So many times we see investors that'll get into a trade, the trade goes against them, then they think about, how do I get myself back to break even? So they take on a little bit more risk, and that trade doesn't work out, and they try to go throw a Hail Mary and say, well, you know, the third time's a charm, and the trade also doesn't work out. And at this point, they've lost so much of their portfolio that they have to do different things to try to get themselves back to break even. And this, unfortunately, like I said, is a slippery slope that I've seen too many times of someone who started off with a small trade that just didn't work out and ended up into a much larger loss in their portfolios. Now, if any of you can relate to this, please type 1 into the chat window to some degree, even if you haven't blown up your portfolio, but just had a small trade that went against you and tried to correct that, if you will, but ended up taking on more risk, and that trade also didn't work out, and you kept doing this over and over again until perhaps you ended up with a much larger loss than you originally anticipated. Now, this is the difference between a finite player and an infinite player. A finite player is too focused on winning that they end up going down this rabbit hole and losing substantially more than they originally anticipated. But if you switch your thought process to realizing that you're not playing a finite game, that there's winners and losers, that your only focus is to stay in the game, what you learn early on is that because this trade didn't work out, winning has nothing to do with it. The trade just didn't work out. Take that small loss, because your goal is to stay in the game. Your goal is not to win. Your goal is to prevent yourself from taking on losses over and over again. If your focus is on making sure that you don't take on big losses, then at some point what you want to do is you want to cut your losers very early in the game and move on to the next trade. So that is the biggest revelation that I think for many investors, that when they're starting out, that they need to learn, because when you're playing the wrong game, you end up being very frustrated in the long run. So that is just a very quick summary of what we learned during that session. Now, again, we had 2 webinars on this topic. So for those of you that missed it, I encourage you to take the time to learn more about this topic, because this is regarding human psychology and human nature and how we view risk and reward, and the biases that we have as human beings. And this is meant to help you look at it from a different perspective, to hopefully avoid some of those biases and prevent ourselves from getting into these type of rabbit holes, because all it takes is one bad trade to knock a significant chunk of your portfolio out of your trading account. And that is always very detrimental to a trading account. And the goal of what I'm trying to do here is to prevent that at all costs, okay? So that's one of the things that we learned. The second thing that we really spent a lot of time on is technical analysis. And we talked about technical analysis because the reason that I use technical analysis is because I started in an industry that heavily relied on technical analysis. Now, when you move on to equities, you have a lot of other forms of analysis. You can do fundamental analysis. There are statistical analysis that you can do. So technical analysis is not the only tool that you can use. However, one of the reasons that I use technical analysis is for a few different reasons. Number one, it provides me with what I believe is an objective view on price, because the technical analysis or a chart just tells you historically where a stock is traded. There's nothing subjective about it. The stock trades at a certain price and exchanges hands at a certain price. That's all that price action is telling me. But more importantly, what it's useful is that it's useful for all instruments with a price. And I say that this is important because in this day and age of security analysis, when you're trading Canadian securities, generally speaking, you're trading predominantly 3 main sectors: banking, energy, and cannabis. So when you're trading any of these 3 industries, generally speaking, you can't just look at the stock price alone. Meaning if you're trading the banks, you have to have a decent understanding of interest rates, because the revenue of banks are heavily dependent on interest rates. So being able to take a fundamental view on a bank is different than taking that same fundamental analysis and applying it to interest rates. So the reason that I like technical analysis is because whatever I use to analyze a bank stock's price, I can use that same analysis to look at interest rates. I can look at interest rates, Canadian interest rates. I can look at United States interest rates. I can look at the differential of those interest rates. All of these things I can use technical analysis for. I can't take the fundamental analysis that I have on a bank and apply it to where I think interest rates are going to go. So there are many limitations to fundamental analysis that may be very useful when you're analyzing a specific stock or specific industry that limits you in other forms of analysis that are important. Also on energy, if you're looking at the energy markets, it makes very good, or it would be much more fruitful if you had a good analysis of where the oil prices are headed as well. And that's, again, your fundamental analysis on energy companies cannot be translated to fundamental analysis of energy or crude prices. So again, being able to analyze not just the market that I'm trying to trade, but ancillary markets or markets that are correlated to what I'm trying to trade, that is an important part of technical analysis and why I value it so much. But more importantly, we all have different time frames that we want to invest in. Some of us like to trade over very short periods of time. Some of you are day traders, or you might hold on to trades for just a few days, and others might hold on to a trade for weeks, months, maybe even years. So how do you take analysis over all these different time frames? And that's really where technical analysis again shines, because it is really applicable to all time frames. The same type of analysis that I do on a daily chart, which is my time preference, you can apply to a weekly chart if you're a longer term investor, or you can apply to an hourly chart if you are a intraday or a much more high frequency trader. So it is really applicable to all time frames. So whatever I teach you here on technical analysis for trading, you can take that same skill set and apply it to different time frames. You can't really do that with fundamental analysis. You certainly can't day trade. You certainly can't trade short term off of fundamental analysis. So those are the reasons why I really prefer using technical analysis, and we talk them in the context of 3 different strategies: buying calls and puts, selling credit spreads, and buying debit spreads. So what we did here during the session last week was we delineated the 2 different types of strategies. And the 2 different types of strategies are where you have a clear sense for direction, but there are certain forms of chart analysis that does not give you a clear sense for magnitude. Meaning, there are some forms of chart analysis where you have a strong case of you think the stock's going to go higher, but you're not sure if it's going to go up 1 point higher, 3 points higher, 10 points higher, 1,000 points higher. Meaning, not every single technical indicator is going to tell you how far a stock's going to move. It just gives you a clear sense for direction, but not a clear sense for magnitude. So for those types of strategies, it depends on how fast you think the move is going to be. If you think it'll be a strong and fast move, buying calls or puts is the right strategy. If you think it's going to be more of a slow and small move, then you want to sell credit spreads. So we talked a lot about the different forms of technical analysis that you can do, or the different methodologies, and which type of option strategy makes sense for that analysis. Then we also talked about strategies where you have a clear sense of direction and a clear sense for magnitude, meaning you have a pretty clear target price as to where you think the stock is going to go. So for those types of strategies, you're best to use a debit spread, because a debit spread is an extremely efficient way to take a bearish or bullish view, a directional view, with the least amount of risk, which maximizes your potential return if you are correct. But they're generally useful if you have a clear target price. If you don't have a clear target price, debit spreads aren't the best strategy for that. So those are the things that we reviewed in the month of June. Again, a lot of information, especially for those of you that did not get a chance to attend. I highly recommend you to go back. And even for those of you that did attend, you might, after today, go back and review some of the material that you've learned. So again, we'll at the end, I'll show you how to access all of that. So what we're going to do is we're going to start off by talking a little bit about, I'll just give you a quick context of where we currently see the markets. The Canadian markets are a little different from the US markets right now because the Canadian markets are a little weaker, but I wanted to show you where we currently stand. So we'll first take a look at the weekly chart. XIU, which is the S&P S60 ETF, has recovered almost about 2/3 of the way of the initial sell-off from the February 19th $27 high, which declined all the way down to almost $17, and now we recovered back to the 23 level. And it's been spending for the past few weeks or so consolidating inside of this range. So for quite some time, it consolidated inside this particular range, started to break out, and now consolidated back into this range. So you have a bit of a triangle now that's been forming here, this consolidation range. Now, I will say that from my perspective, when a market goes this high, this fast, you generally see some form of consolidation before it can either continue higher or break down lower. Now, as far as which direction this is going to go right now, it is difficult to tell. Certainly, markets have taken a bit of a pause. Momentum has certainly slowed down over the past few weeks as new cases of COVID-19 continue to rise, both in the US and globally. That certainly puts the skew of the risk to the downside. But despite all that news, markets have not really fallen since. They have simply consolidated. So from my perspective, if there is a bit of a turnaround in terms of COVID-19 cases, meaning if the number of cases stay relatively, let's call it contained, then that could be the catalyst that the market needs to continue moving higher. If things get worse and maybe the trends don't improve as much as we would like them to, or see them improve fast enough, then the markets might continue to sell off. We don't have a clear indication right now, but we are at the apex of that triangle. So we do expect a resolution of this, or let's call it this market equilibrium, over the next few trading sessions, perhaps the next couple of weeks. That is where we currently sit. It's sitting just between the 20-day and the 20-week and the 200-week moving average. So you do have some major support levels and resistance levels on both the daily and the weekly chart for a potential breakout. So that's where we currently stand on the broader markets. The US markets today opening up a little bit higher from last week, which was decidedly weak, especially going into Friday's close. Today, what we have is a fairly strong market, up about a little over 1%. You have pretty much all US sectors participating on this rally, with industrials leading, healthcare and technology actually lagging behind as the two weakest sectors here today. So, you know, what's interesting, again, one of the things that I have spoken about over the past month or so is the fact that the market rally that we've seen from the bottom is much healthier than the market rally that we saw from November to February, because the rally that we saw from November to February was really just a few mega cap stocks pulling the rest of the market higher. It wasn't the whole market participating on that rally. So from our perspective, the rally that we saw here was actually what we considered a rally that wasn't particularly healthy. So one of the things that you might have noticed is that during each subsequent rally higher from November to February, momentum actually continued to decline. It did not actually improve as it continued to climb. So you had divergence on the way up. And if you looked at the market breadth there, it wasn't particularly strong. Here, the market pretty much, as long as the markets continue to make new highs, momentum also continued to make new highs. So markets were a little healthier here. So there is, in my opinion, despite the risks to the downside due to COVID-19, we do have a much healthier market, which generally leads us to believe that after a period of consolidation like this, it is more likely you get a breakout to the upside than you get a breakout to the downside. But again, with COVID-19, with geopolitical risks, it's hard to say that you won't have a pullback because of other external factors that we can't necessarily account for using our charts. So this is part of why, you know, a lot of questions that I've been getting lately is, you know, do I use fundamental analysis? Do I read the news? I absolutely do. But technical analysis is useful in terms of timing, right? Because the news doesn't really tell me when I expect a big move to happen. The news certainly doesn't tell me, fundamental analysis doesn't give me a sense for when the markets are going to move. That's when I turn to technical analysis. So I might like an industry, or I might like a particular stock from a fundamental basis, but I still want to enter the trade at the most optimal time. And that's really where And that's really where a technical analysis comes into play. So those are the things that we generally keep an eye out for in our trading. So that gives you a quick brief overview of how I'm currently looking at the market. So with that, what I'm going to do is I'm going to pull up some names of some stocks, and I just want to show you how I would potentially play this. I'll look at some bullish names and I'll take a look at some bearish names. So let's start by taking a look at Canadian Pacific Railway. I want to take a look at Canadian Pacific Railway because recently it, just like the market, spent a lot of time consolidating between a period, level. As you can see here, it spent about a month or so inside of this kind of triangle, finally breaking out to the upside, and now has had this recent consolidation range here. And the question is whether a stock like this, can continue to move higher now that it's consolidated for a while, and see if it can continue to move higher. Canadian Pacific Railway, fairly strong stock. As you can see, both the technical score telling me that it's a relatively strong stock compared to the overall market. 1 month and 6 month trend is recent. The 1 month trend is neutral, but the 6 month trend is bullish. And the question is whether or not we can find some bullish plays here on this particular name. So this is just an example of a type of stock that we might want to play here. And one of the challenges here is just the limit of strike prices that are available here on this particular stock. So from an options perspective, may not be the most ideal candidate for buying in terms of using options. I will take a look at selling a put vertical as well as a potential strategy. So one of the things that I do want to point out is the fact that right now options are somewhat challenging to trade because you have this relatively high volatility environment, which generally favors selling options. But when volatility is very high, that also means that risk is high. And when you're selling options, the risk reward is skewed against you. It's hard sometimes to sell options that make a lot of sense. So you have to be really careful when you're searching for these types of strategies as to whether or not you can find an option strategy worth trading. Now, Canadian Pacific Railway doesn't list weekly options, which makes it sometimes a little more difficult to find stocks or trades that you're looking for. So this is an example or an exercise where I might like the stock quite a bit, or maybe I like the technical setup of the trade, but I may not always be able to find an option strategy that best suits my views. Because as you can see here, if I bought a call option, it would cost me $16.45. And based on the OptionsPlay score, that's telling me that these calls are fairly expensive. And when I trade the vertical here, it doesn't get much better. And partially that's because they don't list, here in this particular case, they don't list any strikes above 360, which is challenging to be able to trade if I can't find the strikes that I'm looking for. So that's one of the challenges. And when I look at selling a credit spread, I also find that, and this is something that you'll learn during the credit spread webinar for those of you that want to learn more, is that whenever I'm selling a credit spread, I generally want to collect at least 1/3 of the distance between the two strikes. So the distance here is 330 to 340. That's a $10 wide credit spread. I usually want to collect at least 1/3 of that, which is $3.33. Here, I'm only collecting $2.80, which is not quite enough reward for the risk that I'm taking. Because whenever you're selling a credit spread, whatever you collect in terms of your potential reward, the rest of it is your risk. So the less you collect in income, the more you're risking. So the risk to reward on this trade is all skewed against me. I'm risking almost 3-to-1 here. That's not the type of risk to reward ratio that I'm seeking. So here is a prime example where many times you might do all this analysis and then realize that the options just do not suit your particular trade. And this is one of the challenges of trading options, because you could find a great security and then you might be better off trading the underlying stock. But it's important that you learn these things, because many times I find investors, when they first start learning how to trade options, they just try to trade options on any security without any regard as to the liquidity of that option, whether the options make sense. You just think that if the stock's going to go higher, I'm going to buy a call option. Here is a lesson where not every single time you have a bullish or bearish view on a stock should you buy a call option if you're bullish, or a put option if you're bearish. Sometimes you're just better off trading the stock. Now, this happens to be an example, and I wanted to use this example so that I can show you that even though I'm an option strategist and I advocate for the education and the use of options, I want to make sure everyone understands when you should use it and also when you should not use it, because the worst thing is to use an option when you shouldn't use it. So here is just an example. I'll do one more, TD. This one has substantially more options. And I want to use TD because TD has a very similar setup. It is one of the stronger names out of the banks. Many of the other banks have not cleared what I considered a major level here. So you have this major resistance level that has held for quite some time in March, in April, in the beginning of May, and it finally broke out at the end of May above this level. And now it's come back to retest this level as support multiple times. And the question is whether or not TD can continue to resume its move higher, or it's going to start moving its way back down. Either way, you're at a bit of a pivotal moment here in terms of TD Bank. Now, I will say when you look at most banks, they are not as strong. So if you look at a name like BMO, as you can see, BMO has actually gone back below those levels, those resistance levels that are referring to multiple times. It managed to break just above it, but has now broken back below it. Most of the banking stocks look weaker from this perspective. As you can see, the technical score of 2, 1 month and 6 month trend is mildly bearish. So TD might stand out on its own, but most other banks looking fairly weak. So let's just say, for argument's sake right now, we're going to take a bullish view here on TD, and we think it's going to move higher. We want to look at what option strategies make sense. So if you're bullish here on TD, I would argue that you should probably target somewhere in the $66 range as your first target to the upside if you are bullish on TD. So options here actually look relatively cheap on TD. A call option has a score of 96, a call vertical has a score of 110. And I'm just going to do one more trade for us to compare the two strategies side by selling a put vertical here. So let's say I sell a $60.56, which is roughly, which is $4 wide. 60 minus 56 is $4. I'm collecting $1.35 out of $4, which is just about 1/3. So 135 divided by 400 is exactly 33%, which is 1/3 of the width. So before I said that in the previous example of CRP, I couldn't, or Canadian Pacific Railway, I couldn't find a credit spread that collected 1/3. Here I am collecting exactly 1/3. So this is what I'm looking for on a credit spread. So let's compare these three strategies side by side. So let's say I think TD Bank is going to bounce a little bit higher, right? And I think at the bare minimum, I would expect that it would revisit the $63 resistance level. More likely, it'll get its way back up to around 66 or so if it does make a bullish move here. So let's take a look at those three scenarios. Let's say it gets back up to 63 by August expiration. As you can see here, if I'd sold the credit spread, so a mild move, a slightly mild move here on TD Bank, I'm looking at about $135 profit, or the max reward that I would collect on a credit spread. If instead I buy a call option, I'm looking at a $45 profit on my $255 investment, which is only a 17% return. Not a fantastic return, but the call vertical here at $94 profit on my $206 risk, if you will, which gives me a 45% return, significantly better return. So that's at a bare minimum if I was looking at these three strategies. So obviously, if I think the stock's going to make a mild move to the upside, better off selling the credit spread. I'm going to collect $135. And as you can see, the three strategies risk roughly the same: 265, 255, and 206. I obviously always advocate to risk the least if you can. But as you can see, the return here is not particularly high. So you can ask yourself, well, do I think TD is going to reach maybe 66 to the upside? If you do, as you can see, dramatically, the returns are significantly different. Here, I'm still only going to collect $135 because whenever you're selling an option, that's the most you can make. When I buy a call option, I'm looking at $345, but I'm risking $255. So 135% return, not a bad return. But as you can see, the strategy on the right, because I risked the least amount of $206 for $394 in profits, that's 191% return. So even if I think the stock's going to revisit its recent highs around $66, as you can see, the strategy here on the right-hand side is the one that is going to give me the best risk to reward ratio. So you just have to ask yourself, well, how far do I think TD Bank is going to rise? If I think it's going to rise by a mild amount, then I might want to sell a credit spread. It's right here. But if I think that the stock's going to make a relatively sizable move to the upside, then I'm better off trading this strategy on the right-hand side. So this is meant to help you better understand how to look at these strategies, analyze it, and get a sense for where you think the stock's going to go. And I'll just give you one last example before we open this up for your symbols. So if you guys have some symbols that you want me to take a look at, type them into the chat window with whether you're bullish or bearish on that name. I'm happy to take a look at this after I look at, I just want to show you TRP. TRP is a simple, another strategy that we were looking at, or another symbol that we were looking at. So similar type setup, but broke down to the downside. So as you can see, traded within a range, broke that support level. It is now coming to test that support level for resistance and might start moving to the downside. So this is just the exact same type of trade, but just a bearish view here on a specific name. And the goal here is to show you how you can buy a put option versus a put spread. Now, because this is a trade where I have a clear sense for magnitude, because I have support levels before that I can target. So if I think it's going to hit maybe, let's say $52, which is the next support level, or maybe even 46 to the downside, I can see, well, if the stock goes down to 53, which is the next support level, I'm looking at about 104% return on the vertical spread, 58% return on the put, or 7% return on shorting the stock. Or if it does move to those extended targets down to 46, then I can see that buying the put option is the best strategy because it gives me 280% return versus only 226% return if the trade goes in my favor. So you can use these tools to take a look at your symbols that you want to take a look at. You can select either I'm bullish or I'm bearish to see which strategies best suits you. And then more importantly, be able to use the P&L simulator to see what are your potential returns and losses if the trade goes in your favor or if the trade goes against you, to show you how they all perform side by side. So this is designed from the ground up to allow anyone, even if you're not as familiar with options, to be able to quickly look at a strategy and understand whether it's suitable for you. So with that, let's take a look at some of the symbols that you guys requested. Let's see. TD has one of the largest U.S. exposures. Is that a reason that it's mimicking the S&P? I'm not sure what you mean by TD as one of the largest U.S. exposures. You mean if you're talking about out of a Canadian bank that they have a lot of U.S. exposure? That might be true. I don't think that that's a reason that it would be, oh, you're mimicking XSP, which is the banking index. Yeah, so, but I think banks in general mimic the banking index. But yes, I would generally agree with that statement. Lightspeed, Lightspeed, I don't know a whole lot about this particular name, but one of the things I will say is that it's been trading against that resistance level for quite some time. You have this kind of triangle that's forming here. I don't know whether it's going to break out higher or break out lower, but I would wait for that breakout before I look for a move. And this is a classic wait and move here. You can certainly bet in one direction or another, but I would wait for that breakout. And it looks like it might be starting to break out to the bottom, but hard to say. I don't know a whole lot about this particular stock, so I don't have a lot to comment other than I think that you want to wait for that breakout. Chris is asking for Max R. So I also don't know anything about this particular stock, but this stock has recently just broken out above that $24, $25 resistance level. Looks like it's consolidating for a few trading sessions above that level and maybe waiting to continue to move higher. But I will say options are not very liquid here, or they're very expensive. So here's an example of a stock that you might really like the stock, you might really like the technical setup, but the call option and the call spread may not be the best strategy to take. Now, Maxar, I'm guessing, is a relatively small cap stock. Thomson Reuters really has this, especially if you zoom out, what looks like a much longer term kind of head and shoulders formation. Does that mean it's going to head lower? Not necessarily, but it certainly is a relatively weak stock, in my opinion, in recent past. you know, you kind of have this triangle here also that's going to resolve itself. Is it going to break out to the upside? Is it going to break down to the downside? There certainly is a lot more room to go to the downside than to the upside. You know, I think upside you have first target around 96, secondary targets around 100. So I would watch to see for that breakout before I decide. Calls, you know, you can certainly trade a call spread. If you think it's going to go higher, you can trade that 92-100, which gives you a very good defined move up to that second target, risking only $319 on a $92 stock. So you're risking about 4% of the underlying stock price to take a bullish view. That is the type of strategy that I would prefer to take. And if you're bearish on Thomson Reuters, put spreads also might be an interesting way to play it, because you're risking about 5% of the underlying stock, and this can go down to about 70, you know, let's just call it 78 or so. If this does move down to $78, you're looking at about 170 to 190% return on your stock, on your investment, while risking somewhere in the 4 to 5% range to take that risk to the downside or to the upside. So that's how I'm looking at Thomson Reuters. SPY, I'm not going to look at any US symbols here. This is just for Canadian symbols. TED, bearish on TED. I'm not sure what TED is, but that's not a symbol. If you don't mind clarifying, I'm happy to take a look. We've looked at BMO already. NVU, which is Northview Apartments. I don't know much about this particular stock, but the way the stock is trading, it almost seems like the stock has been acquired. I don't know anything about this particular stock, but you have this pretty big triangle that's now being formed, and it's about to reach that equilibrium. Again, the way that the stock has traded over the past few weeks almost feels like the stock has recently been acquired for that $34.50, $35 level. It's trading around that level. Again, I don't know anything about this particular stock. If it has been acquired, I don't recommend you to trade any options on it. But if it hasn't, perhaps it's about to break out. But again, I don't know anything about this stock, so it's hard for me to comment as to where it's going to move. DOL from Peter. DOL. Dollarama. Dollarama is one of the major competitors for Dollar General and Dollar Tree, or I forget if they are a direct competitor if they're owned by them. But both of those stores have been doing relatively well in the United States, especially during kind of a COVID environment. Notice that it is just approaching that support level. It was resistance for quite a bit of time, finally broke out above it, but is now to retest that. Is it going to start moving higher? It certainly has strong relative strength. 1 month and 6 month trend is looking fairly neutral here, but it is still above that $45 resistance level. So this could be the support level that you would want to go either long, or if it breaks below 45, the level that you want to start shorting. But you know, from my perspective, especially as you see a uptick in terms of COVID-19 cases, and social distancing and not eating out at restaurants is likely going to stay here for a little longer. These are the types of stocks that tend to do relatively well during that time. Bruce wants to take a look at Shopify. Shopify has just been continuing to be strong and taking off. At the moment, you know, the fact that it broke out above that 1250, 1200 level leads me to believe that there's still some further upside here in this particular name. But keep in mind, options here. So they haven't listed quite enough options. I'll have to take a look if there's any issues here on the option chains. But I don't see enough options here to trade Shopify at the moment, unfortunately. I will have to look at that. PKI. PKI. So this is a stock that is somewhat interesting because from my eye, this looks very similar to what I would consider a very formal head and shoulders topping formation, which is generally a pretty bearish setup. So I would be more on the bearish camp here in this particular name, especially when the technical score is 1 and the 1 month and 6 month trend is weak. This tells me that this stock is underperformed and is trending lower, so it's likely to continue to underperform. And I would prefer looking at buying puts or put spreads, both of which actually are not that expensive. So at least for a stock that moves. So that's my view here on PKI. Enbridge, I think I talked about Enbridge briefly. Enbridge also looking relatively weak. Technical score of 2, 1 month and 6 month trend is bearish. I don't think this is a surprise to anyone that the energy names are looking fairly weak right now. There is, in my opinion, more likely that these types of names continue to move lower rather than higher. I know that Enbridge is a little different from the perspective of they're not just in the necessarily the oil space, they're much more in the natural gas space. But generally speaking, someone paying a 7.6% dividend yield, that leads me to believe that the company is in a bit of a distress from a financials perspective. So fundamentals may not be as strong here in this particular case. Brookfield Asset Management. Brookfield, this stock has not really been able to rally with the rest of the market. As you can see, it couldn't really get back above that $49, $50 resistance level and is now trading lower. This is a much more neutral stock in my opinion. I would prefer to be selling credit spreads on this type of name because I don't have a strong view that it's going to move significantly higher or significantly lower. I think this is more likely the type of stock that's going to be range bound for a while. Selling credit spreads are suitable for that type of market environment. CGX, and you're bearish on CGX. Simplex. The movie theaters really have been struggling, and they tried to rally with the travel stocks a couple of weeks ago, but really come back down. Also, anything paying a 12% dividend yield, typically you generally don't see strong, fundamentally sound companies paying 12% dividend yield. There's probably a likelihood that that dividend will get cut. Granted that information may be already implied in the markets. I haven't looked at this specific name yet, but it is important to remember that anything paying a 12% dividend yield likely is in a bit of financial distress and will likely have to cut their dividend yield. So that is something to consider when you're investing in a name like this. But to the downside, puts are not cheap. $1.65 for a $10 put means you're risking 16% of the underlying stock price to take a bearish view by August. So the stock has to move 16% lower just for you to break even. Now, granted, this stock moves. This stock moves a lot. $1.65 move for on a $9 stock. But as you can see, the stock moves $5-6 in a week. So you might get that kind of move to the downside. I do find timing on this a little tricky because it's hard to know exactly when it's going to fall through that support level, but it certainly looks like it's starting to do that. It's broken below $10 already, which also probably is a bit of a psychological level for many investors. For a stock to fall below $10, you might get some selling. So buying a put option here is certainly the strategy to take, but just be aware of how much you're actually risking. It's 16% of the underlying stock price. That's a lot to risk. TFI International, very strong stock. Looks like it's just about to break out to the upside here around that $46 level. Looks like it's just breaking out. I don't know much about this particular stock, but as you can see, call options aren't particularly cheap. Call spreads also isn't particularly cheap. So this might be the type of name where you're better off trading the stock. XME mining sector. So I don't know. I'm not familiar with XME. I don't know. Is that a Canadian symbol? Oh, XME is a US-based symbol, so that's why I'm not able to find that here. We're only looking at Canadian symbols here. CNR, Canadian National Railway. I would imagine that the stock looks similar to Canadian Pacific, which it sort of does. You have this resistance, this support level around 115 or so. It's topped around there. It looks like it's starting to break out a little higher here. So I would have more of a bullish view on Canadian National Railway, but options here are not particularly cheap. So be careful on this type of stock as you're looking for perhaps some bullish opportunities here on CNR. DOL, did we already cover? Oh, we did cover Dollarama. Carlos and Ed, we're only looking at Canadian symbols here. Carlos wants to look at AC, Air Canada. Let's look at Air Canada. Now, Air Canada looks actually quite weak compared to even some of the other airlines that did manage to break out to new highs and then came down. Air Canada didn't really break out to new highs and is coming back to lower. And so I think, I think airlines are going to continue to struggle. I think you're going to see a lot of range-bound action here, as you have seen so far in the airlines. I don't have a strong bullish or bearish view on these particular sectors, but you are collecting a lot of income. So keep that in mind. If you're selling a put option, you're collecting 5% of the underlying stock price to sell a put that expires in 25 days. Cover calls, same thing. If you go out to August, you're collecting 5% raw return on the cover call. So if you own Air Canada, you might want to consider selling some puts to acquire the stock if you like the stock, or sell some cover calls to augment the non-paying dividend yield that you have here on Air Canada with some, you're looking at 5%, almost 6% in 2 months' time. Those are the types of yields that you can get in this high volatility environment in some of these names. So those are the ones that you want to take a look at. Okay, wow, so many more symbols. I only have a few more minutes, but hopefully I can get through as many as I possibly can. CCO, Cameo. I don't know anything about this particular company, but one thing I will point out is that from a technical analysis perspective, you have this very strong rally followed by this recent consolidation period, of which, generally speaking, you get a breakout to the upside. And the breakout of the upside is usually based on the measured move of the previous move. So you have quite a bit of room to the upside. But what you want to see is the stock to break out of this range, which it has not broken out just yet. So I would wait for that breakout before I would consider going long. And there's always a risk that it breaks to the downside. But again, very strong name. I think that you're likely going to see a breakout to the upside rather than downside. Okay, I've already taken a look at most of these. Can you please check SRNE? Is that a Canadian symbol? I don't believe so. Yeah, that's a US-based symbol, so I'm not going to look at any US-based symbols here. CNR, we've already looked at Canadian National Railway. JWEL, Jameson Wellness. Not familiar with this stock, but it is interesting that it is near a what looks like a fairly significant double top here around 34. Is this just going to reverse back down into the 30s? Hard to say. I don't know anything about this company. If you have more of a fundamental view, if you're bullish on this, I would wait for the breakout above 34 before you went long. If you're neutral, if you're bearish, I certainly think that you have a good shot of this stock, holding this double top. So I would sell a call credit spread that would capitalize or profit as long as the stock kind of stayed in this range-bound area, which is where it has been predominantly between 31 and 34. So selling a call credit spread when it's near the upper band of that range and selling a put credit spread when it's at the bottom of that range, that would be the type of strategy that I would take. But once it breaks out above 34, that's when you might see some extended moves to the upside. Okay, so I've taken a full hour here and I've really tried to go through as many symbols as possible because, again, I wanted to show you just how generally easy it is for someone who you don't have to have a lot of knowledge of each individual name to still have a decent directional view. That I do recommend that if you don't just place trades purely based on technicals, because fundamentals still matter quite a bit. You need to understand what a company does. You need to understand how they make their money to be able to assess whether or not, especially in this type of market environment, whether you think they're going to do well in a post-COVID-19 world. It's important that you understand how much do they generate in terms of revenue, how much, are they profitable? These are all very important things that you should be aware of before you invest in any type of company, bullish or bearish. It's just that technical analysis helps us time those specific bullish and bearish views that are more based on fundamentals, so that you can extract the best possible return out of your trades. Because you might be bullish on this particular name, but technical analysis is telling you just wait a couple of days so that you can time your trade so that you might be able to capture that next big move to the upside. Versus if you don't time it, if you don't look at technical analysis, you just go long as soon as you have a bullish view on a stock, you might find that this stock maybe goes down a little bit, then starts moving higher, move down a little, and finally breaks out. And at that point, you might have an options trade that's already expired before that breakout. So that's why technical analysis is so important, to overlay with more of your fundamental view of an underlying stock. So I hope that this was useful in demonstrating to everyone how to utilize technical analysis in your trading and how to use the charts to determine what might be the best strategy for you, because options play is really designed to allow you to place any three strategies side by side and see how they perform in different types of market environments. Sometimes you think the stock's going to make a small move, other times you think it's going to make a big move, and you just want to make sure that you understand what type of option strategy is best suited. As I showed you in many examples, sometimes you're better off selling a strategy and not looking for a big move. Other times you might be looking for a big move to the upside. And some of the examples that you guys showed me today, I think have a huge upside potential. But again, just like this Jameson Wellness, I don't know anything about this particular stock, but if you like the stock from a fundamental story perspective, if you do get a breakout to the upside, look at how big of a move this stock moved to get to that $35 level. It moved almost 50% from this $24 level all the way up here. So after a big move, it makes sense for the markets to consolidate for a time before it can continue moving higher. But this stock can go into the 40s or perhaps even 50s to the upside if you do get that breakout. So a lot of potential, but you still want to make sure you time that potential, especially when you're trading options. And that's why technical analysis is so important in my discipline of trading, to allow me to time my trades correctly. So again, I hope that this was useful in helping you guys understand how we utilize and look at the markets using technical analysis, how we use options play to look at the different strategies side by side and get a sense for how to go about trading it. So for those of you that if this is your first time joining us for an education session, welcome. You can sign up for the tool itself free of charge by going to optionsplay.com/TMX. And for those of you that missed our first course, the advanced course, the first parts of our advanced course, I'm also posting a link to our YouTube playlist just on the advanced master course. If you're brand new to following us on Facebook, on YouTube, I recommend that you subscribe so that you can get a notification every single time we post a new video. Like I said, this is designed from the ground up to really help you do your trading. This is designed to help you better understand what tools you have access to, making sure that you have the education so that you know how to utilize the tools. And we do these sessions to make sure that you also see all of this stuff in action using real symbols here. So this is, I hope this is useful for you guys to get a better understanding as to how to use options play. So with that, thank you so much for taking your time out here this afternoon. And we will make sure that this recording gets out to everyone here in the next couple of hours, making sure that you guys have access to the recordings, the slides. And then if you have any questions, you can always join us for these webinars or email us. You can actually submit your questions directly from Options Play. So if you're in the Options Play tool and you have a question, you can submit them to us directly on your platform. You just click, you just type it in, click next and send, and that's it. And we'll be able to respond to you by email. So please send in your questions if you have any questions, and I will see you guys next time. Have a great afternoon.